So what exactly is Wint Wealth?
So currently we look ourselves as a fixed income destination for retail investors.
How much money have you raised?
We've raised about $20 million, so about 150 crore.
Okay. And what is the definition of influencer? I know that
you need to have more than a million followers.
Does Nitin qualify as an influencer?
If you look at these NBFCs which we work with, right, they want access to retail capital. Today their main access of capital is either institutions like banks or like large NBFCs or mutual funds. These NBFCs are not Mahindra and Bajaj. They might have a fantastic financial health, but how would retail investor would know?
Even for like beyond 5 years, I don't think someone should be investing 100% of the money in equity.
The credit rating agencies here in India are subsidiaries of global sort of firms. And do you think the ratings themselves are reasonable?
Let me put it in this way. Rating agencies can be a lot more efficient. Many a times they tend to lag the price that market is giving the issuance, wherein even AAA bonds have ended up defaulting.
Rainmatter invests in fintech startups with the intention of investors doing better with their money, which we believe will also help deepen markets in India. Join us as we speak with the startups and venture capitalists who invest in them about how they are approaching markets, fintech solutions, in all subsectors of lending, payments, investments, insurance, and infrastructure, as well as their businesses from scratch.
Hello and welcome. I am Hansi, and today we are talking with the founders of Wint Wealth. We welcome Ajinkya Kulkalni, the CEO, and Anshul Gupta, the CIO, Chief Investment Officer, co-founders. Welcome.
Thank you for having us.
Thank you.
Okay, so let's dive right into the crux. What was the big problem statement that led you to the start of Wint Wealth?
So people want better fixed return products, right? So people want some alpha in fixed return, right? So they want something that gives them higher return than FD, but is not as volatile or as risky as equities, right? And in some sense, people were solving this problem by themselves in older generation at least, right? So they would book an FD in a local cooperative bank or a credit cooperative society, which gives about 2-3% higher than SBI FD probably. Or they will make some jeweler scheme, which is generally called Kuber, some Kuber scheme. You pay 1,000 rupees for 11 months, and in the 12th month, you get either 12,000 rupees back or you can get gold worth 12,000, right? That's in a sense was a fixed income, right? But there was no such digital option, right? Which could, and a large set of supply actually for these assets, right? So basically double-digit fixed return was what people want, and they were not credible options. And the thing is, these options were not available for retail investors. These products were available for HNIs, ultra rich people in a higher ticket size, like minimum investment 50 lakh, 1 crore, right? We said we want to invest in this. We don't have that much money. How can we do it at 10,000 rupees? The answer was yes. You had to solve for first regulation, then education, and then distribution, right? These three things. And this is what we started solving at Wint Wealth, right?
So what exactly is Wint Wealth? How would you describe it in one sentence?
Yes. So currently we look ourselves as a fixed income destination for retail investors. So we'll have all kind of fixed income products. We started bonds. We already have SGBs. We'll have FDs. We'll have REITs, InvITs. So all kind of fixed income. So everything non-equity, right? We will have on Wint Wealth platform for retail investors.
So we have these three things. We have the platform, we have the product, which is bonds, and we have retail investors. Let's start with the easiest of the three, which is the product. Okay. What is a fixed interest instrument? It's a basically a sort of a loan, right?
Yes.
And people understand fixed deposits, you think?
Yes.
Yeah? Okay. So could you give us a little bit of background on what, other than fixed term deposits, what does the rest of the fixed interest market look like? People may understand government bonds, but maybe perhaps just give us a rundown of the bond market in India. What is available apart from government bonds? Perhaps,
sure.
Anshul, you.
So you kind of disagree with what you said, that people understand government bonds. Like if you look at the bond market in India, it's very nascent. Hardly 1.1% of the people will be participating in the bond market. And 0.1% is also a large number, maybe like much lower. We have the RBI Retail Direct statistics, which is the retail portal for investing in government bonds promoted by RBI.
Which is a very recent thing, right?
Yeah, it started
so-
like 2-3 years back.
Right. Okay. So let me rephrase that question.
Yeah.
If you could give us maybe an overall summary of the bond market, how big is it?
It's roughly I think like 5 to 10 lakh crore, but completely institution dominated.
Right.
Like retail participation is nil, literally nil. There are like 2-3 reasons for it. One is lack of access, which is what we are trying to solve. Second is lack of education, which again we are trying to solve via Wint. And third was regulations, which has been partly solved, but it's still like a work in progress. And regulatory aspect was like till very recently, till like 6 months back, the minimum ticket size to invest in a listed bond, privately placed listed bond, was 10 lakh. At 10 lakh entry barrier, it's not a retail product. It's a HNI product. And HNIs were kind of investing via their wealth firms, advisors, family offices, etc. But like 6 months back, SEBI drastically reduced it to 1 lakh. Now, even at 1 lakh, it's still not like a completely retail product, but still I'll say a mass affluent product, which means guys like Ajinkya and I can still access in that 1 lakh instrument. There is another category of bonds called as publicly issued bonds. There the ticket size is 1,000, but that's only 1% of the entire bond market. So not like a lot of choices are there in the publicly issued bonds. The 99% of the market is privately placed bond, where the entry size was 10 lakh till 6 months back. Now it has been brought down to 1 lakh.
Okay, so now just give us a breakup of the bond market. How much is government bond? How much is non-government corporate high yield? If you can give us a breakup.
Like majority is still like AAA in terms of like rating distribution in the private bond market space.
So you say private meaning corporate?
Corporate bond market.
Right.
Within
Within corporate, there's like NBFCs and there's like corporate.
Yeah. So it can be like fragmented via various parameters. One is on the which sector the issuer is operating, whether the issuer is operating in NBFC sector or non-NBFC sector. Second parameter can be what's the rating of the issuer. Is it AAA rated, AA rated, single A, triple B, and below triple B is non-investment grade, and so on. If we talk about sector fragmentation, I think 60 to 70% of the issuances are from the NBFC or banking sector. The non-financial issuance is still limited because it's for NBFCs and banks that cash is the raw material. So they're always out in the market to raise more and more money to fuel their business. But for non-NBFC sectors, the capital requirement is more like one-off. Like for manufacturers, it may be to like fund the working capital of a plant and machinery and so on. So it's not a recurring requirement for them. But for NBFCs and banks, cash is ultimately the raw material. And hence, they are the biggest issuers as well in the bond market. Coming to the rating distribution, our bond market is still like not that deep. Majority of the issuances are still happening in the AAA and AA rating category. In terms of volume, I think 80 to 90% will be in these two rating categories, and balance 10-15% will be in A and BBB rating category.
So the issuers, the credit rating agencies here in India are subsidiaries of global sort of firms. Do you think that people understand, and do you think the ratings themselves are reasonable? I mean, AAA seems to be a very high sort of rating for majority of the market.
Correct.
I mean, how accurate would you say it is?
So let me put it in this way. Rating agencies can be a lot more efficient. Many times they tend to lag the price that market is giving the issuance. Like we have seen a lot of cases wherein even AAA bonds have ended up defaulting. But the same bonds were trading in the market at, let's say, BBB category pricing, which means rating agencies were not doing timely rating action, but market was pricing it much ahead compared to rating agency.
Right. Okay. So therefore, what you're saying is where there were very highly rated bonds and the market was pricing them at BBB, there was obviously a mismatch. There was something going wrong. So you're saying the agencies were the ones not pricing it.
This is one problem. Second problem is with respect to rating models as well. In India, the rating agencies predict probability of default. But if we talk about actual risk, what is the risk? What is the probability? some issuer will default. And second is, in case if the issuer were to default, what will be my loss? Let's say if I give money to Ajinkya. The risk is, let's say, what is the probability Ajinkya doesn't pay me back? And second risk is, let's say if Ajinkya doesn't pay me back, how much will I end up losing? Because what matters to me is how much money I'm losing. But rating agencies are rating only the probability of default, not the loss given default. Which means, let's say, continuing with the same analogy, like I gave a loan to Ajinkya. Let's take two scenarios. Scenario one, it's an unsecured loan, which means there is no collateral whatsoever. Second scenario is, let's say I gave 1 lakh rupee to Ajinkya, and in return he gave me 1 lakh rupee worth of gold as collateral. That tomorrow if I don't pay, here is my gold, sell in the market, recover your money. If Ajinkya were to default, in scenario one, probably I end up losing my entire capital. In scenario two, I may not lose anything because I have liquid collateral, which I can sell in the market. But rating agencies will give the same rating to both the loans, because they're only rating what is the probability Ajinkya will default or not. What's the underlying structure, what's the underlying collateral, how much money I will lose. They don't give any weightage whatsoever. So in this example, a rating agency will give the same rating to an unsecured loan and same rating to loan backed by gold collateral. So there is, it's more nuanced, there are a lot of variables, because of which ratings are not the complete, you cannot just rely on the ratings to do the underwriting.
Sure, fair enough. What about the different types? You brought up collateral. What are the types of bonds available in the market, being secured or covered or and so on?
So broadly, there are 4 categories of bonds which are there. The safest are senior secured bonds. Slightly more riskier are senior unsecured bonds. A more riskier category is something called as subordinate bonds, and the riskiest are perpetual bonds. These are the 4 category of bonds which are there. Now, what differentiates these bonds is one, the security, and second, the underlying collateral. Senior secured bonds are the safest. They are the senior most and are backed by some kind of collateral.
Sure.
Senior unsecured, they are senior compared to subordinate and perpetual bond, but they don't have any collateral whatsoever. Third are the subordinate bonds. They don't have any collateral and are junior to senior secured and senior unsecured. And last are the perpetual bonds. They don't have any collateral whatsoever. They stand last in the queue amongst all the debt investors, and obviously are the riskiest. Also give you higher returns, but are all very risky compared to the other 3 categories. When I say seniority, it means, let's say if the company were to default, where in the queue you will be standing. Senior bondholders will be first in the queue, then will be the subordinate bondholders, and then will be the perpetual bondholders.
Sure. There is also covered bonds. Can you talk through collateralized sort of bonds?
Correct. So they used to be there in India till 2021, but subsequently RBI came out with some regulations, and post those regulations, covered bonds cannot be structured in India anymore. So theoretically in other geographies these bonds do exist, but practically speaking, post 2021, no covered bond has been structured in India.
And are there also asset-backed securities and mortgage-backed securities available in the market?
Correct. Those are off-balance sheet borrowings, so not bonds per se, but these are something called as securitization instruments. Now let's say a company needs money. It can raise money in primarily 3 ways. One is raise equity capital. Second is raise debt, which is on-balance sheet borrowing. Third is by something called as securitization, in which it sells some of the assets the company has to a third party. That is called as securitization. In case of banks and NBFCs, the underlying assets will be loans that the bank or NBFC has given to its end borrowers. So let's say a NBFC has 1,000 end borrowers. They can take 50 of those borrowers, and the money due from those 50 borrowers can be sold to a third party. That I'm expected to get, let's say, 1 crore rupee from these 50 borrowers. You pay me 80 lakh upfront, and that 1 crore will directly come to the investor. So that's the third route via which the company can raise money, and this is called as securitization.
Of the whole Indian bond market, what is the breakup of all of these different types of instruments?
Sure. I'll talk about NBFCs because they are the largest issuer. NBFC balance sheets, including housing finance, is roughly in the range of 25 to 30 lakh crore. This includes vehicle finance, microfinance, MSME, housing, tractor finance, two-wheeler, gold, unsecured, consumer durable, and miscellaneous sectors. Securitization is roughly 2 lakh crore market. NBFCs are operating at a leverage of ballpark 5x. So 5 lakh crore will be equity capital. Balance 15 to 20 lakh crore is the on-balance sheet debt they are taking. Within the on-balance sheet debt, 30 to 50% will be coming from bond market, depending on how the market is. So roughly 5 to 10 lakh crore is coming from the bond market. 10 to 15 lakh crore is coming from bank financing. 2 lakh crore from securitization. And 5 lakh crore is the equity capital that they have put in.
And credit is one of the fastest growing segments, I guess, in the fintech space, right?
Correct.
So how sort of fast do you expect this whole segment to grow?
It's an interesting question.
Compared to GDP, say, for example, is it a multiple of GDP?
Let's look at the credit growth at a economy level. It's growing in the range of 14 to 17%, depending on which month we are looking at. Slightly higher than the nominal GDP growth rate. Fintechs, on the other hand, are growing in the range of 30 to 40%. Interestingly, like Sanjeev Bajaj in 2021 famously said that I see a lot of fintechs with a unicorn valuation, but show me a fintech which has a unicorn or let's say $1 billion portfolio. And there was none in 2021. But if we talk about today, there is Cred, which has more than $1 billion AUM. There is Navi, which has more than $1 billion AUM. There is Moneyview, which has more than $1 billion AUM. So in 3 years only, we have seen such high growth in this sector. And the sector is growing at 30, 40, 50% year on year. Interestingly, a lot of new to credit customers are being onboarded by fintechs,
right?
Which means the financial inclusion that the country wants, the end mile connectivity, giving loan to someone who has never availed a loan from the financial sector, is what a lot of these fintechs are doing. Because they are operating by a platform, have the digital reach, even underwriting a 10,000 ticket size loan is possible, and which is what these fintechs are looking to.
So is the growth coming from a lot more sort of cash flow based or invoice based sort of collateral rather than hard collateral like?
Yeah, all these are like unsecured loans mostly.
Right.
Fintechs, most of the fintechs are targeting a personal loan segment. They are like fintechs like Paytm who are targeting business merchants as well because that's their predominant customer base.
Right.
But the guys I spoke about, Cred, Navi, Moneyview, etc., they are all in personal loan segment. While folks like Paytm, they are more into a business loan segment where the underlying underwriting is done on cash flows. Even in the personal loan segment, the underwriting is mostly on cash flows only. No fintech is like focusing on collateral based lending. It's a very competitive space. You need feet on ground because if the person were to default, you need to liquidate the collateral, for which you need feet on ground.
So as that fintech segment grows in the lending space, the flip side of that is that they have to raise capital or they're securitizing their sort of loans, and that is what you are investing in, right? So the names that you mentioned, are they the sort of names that would end up on your platform?
So we are not into securitization market. We are only doing senior secured bonds. That's our flagship product. We do work with like some fintechs, but it's only a small portion of our portfolio. The entities that come on our portfolio, these range from AA category entities, like Muthoot, for example, 5-star, for example, Vastu, for example. Then there are A category NBFCs as well, having balance sheets in the range of, let's say, 5,000 crore, 6,000 crore. Can be in vehicle finance, MSME lending, housing finance, etc. They can be 1 or 2 fintechs as well. Like Navi is our partner, existing partner. And then selectively we do operate in BBB category as well, wherein the NBFCs will have a portfolio in the range of 500 crores to up to 2,000 crores. So Wint is a curated platform wherein we do our own diligence, understand the systems, processes, operations, financials of the company, and only those companies which meet our diligence filters get onboarded on the platform. So it's a key distinction that it's not a marketplace. It's not like any and every NBFC can get onboarded on the platform. Our team does the diligence, and once we are satisfied with the diligence, then we onboard the NBFC onto the platform.
So when you say you do the diligence, you are acting almost like what a fund manager would in the case of a debt mutual fund, right? I mean,
In
you are
some ways,
pricing
yes.
it. You're saying if this is a 9 to 11% yield, this is an appropriate yield for the credit rating that it has, right?
Yes. In some ways, yes, we are doing the curation.
Right.
We are
In fact, we go one step further. We also have skin in the game.
We'll get to that, but
Yeah.
certainly you are picking the bonds.
correct.
And I know you were saying curation, but in a way, you're saying have 10 bonds in your portfolio. Are you also saying which 10 bonds an investor should have? Or
We
you're saying
can't,
any 10 bonds?
We
you
can't
pick?
legally advise. What we say is ki these are the 30 NBFCs we have brought on the platform. We have done our diligence. We are personally comfortable investing in these NBFCs. From company's balance sheet, we are having skin in the game. Now it's up to the investor to pick and choose which 5 NBFCs, which 10 NBFCs the investor wants to pick in their portfolio. Legally, we can't advise investor that invest here, invest there. That's the role of the advisor of the investor.
Okay, so you expect investors to have advisors when they
Either
come to
advisor
you?
or like do it on their own. But legally, we can't advise that this security to do.
Yeah, okay. We'll come to the investing part as well. But just finishing off the product, so you're basically offering these senior secured bonds, mostly of NBFCs.
Correct.
Not the fintechs, but you have some fintech partners, but
Correct.
mostly of second tier NBFCs, would you say?
Uh,
In terms of size?
in terms of size, yes, because I mean we can offer like a AAA NBFC bonds as well. But the thing is like a AAA bonds in India are getting priced at 7.5 to 8 quarter.
Right.
That's the AAA pricing that a bond will offer to the investor. If you look at the FD yields, which a lot of banks are offering to the investors, where up to 5 lakh there is government guarantee. Banks are giving yields in the range of 8 to 850, even 875 in some cases. And those FDs are liquid, which means by paying a 1% penalty, you can get your money back. It's backed by sovereign guarantee up to 5 lakh. So what we tell investors is like rather than investing in a AAA bond where the yield is 775, 780, rather invest in a FD because we are catering to retail investors.
Sure.
Till 5 lakh, it's like as good as government bond because quasi guarantee is there. And that's why we are bringing FD also on the platform. That if an investor wants to invest in super safe asset, go for FD. Like these bonds should give at least 100 to 250 basis point alpha, then only it's worth taking the risk.
Okay. Why would you call it alpha? Isn't it high yield? I mean, alpha is supposed to be
Yeah,
manager's skill.
correct.
Here you are actually picking slightly riskier bonds. So just so the retail person understands, what is the difference in probability of default in the 9 to 11% range compared to the FD?
So FD there is like 0% risk. If I were to quantify the defaults which have taken place in A and BBB category, historical rating agency data, and this is probability of defaults. This doesn't include a loss given default. It's been in the range of 1 to 2%.
So 1 to 2% of the time they should expect a default, not necessarily what is the haircut they would expect?
Then that's where the structure comes into play, the underlying collateral comes into play, and I'll like maybe take a couple of minutes to explain how we mitigate the risk by structuring as well. 95% of the bond market in India, or more than 95% of the bond market, is something called as bullet bond, which means if it's a 3-year bond, the money along with the principal along with the interest will be paid at the end of 3 years. What we do at Wint is something called as amortizing bonds. Which means, let's say if you're investing 1 lakh rupee, the money will be repaid back to you in tranches, in EMIs. The beauty of this structure is, let's say there are 2 bonds, 3-year bond. One bond A is bullet, bond B has quarterly installments every 3 months. Let's say if the issuer were to default after 2.5 years, in bond A, 100% of your money is at risk. because the entire money is due after 3 years. In bond B, which is amortizing bond, 80% of the money or more than 80% of the money would have come back to you. And only 15 to 20% money will be stuck in the bankruptcy proceeding, and whatever haircut or recovery happens, depending on the collateral, you'll receive your money. Hence, at Wint Wealth, we strongly prefer amortizing bonds over bullet bonds. So even if that 1 to 2% of the scenarios were to crystallize, maybe 60%, 70%, 80% of the money would have already come back to you. Because it's very unlikely, like we bring a bond today and next month the default occurs. The default will occur maybe 1 year down the line, 2 years down the line, and so on. Second thing which we are doing is we are bringing low tenor bonds. Majority of the bonds, like almost 80% of the bonds, have tenors between 12 to 24 months. So that in turn reduces risk. Unlikely, like a company we have diligenced will go down in 1 to 2 years. So that again reduces probability of default. Third is all these are senior secured bonds, which means they are backed by some kind of collateral. Typically, the collateral is 1.1 to 1.2 times the underlying bond amount. But let's say an entity were to default, depending on the how much time the bankruptcy proceedings take, what's the economic environment, etc. I think there will be decent recovery. My sense is more than 75% of the recovery should happen for the investors.
So when you say structuring, do you get involved in actually advising these NBFCs in the structuring?
Yes, we are involved in the bond issuance process as well.
Right.
In the term sheet discussion, in the structuring, what will be the amortization, what will be the collateral. That's why like we are curated platform. It's not like we are buying bonds from the secondary market. These are bonds which we have originated, we have structured, and thereafter we are bringing on the platform.
And therefore they're only available on your platform. The same structure, same bond would not be available on another platform.
I'll say like 80 to 90% of the bonds are fall in this category to be in the interest of transparency. 10 to 15% of the bonds we may purchase from the secondary market as well. But yeah, almost 80 to 90% of the bonds will be bonds where we have done the origination, we have done the curation, we have done the structuring in terms of what will be the amortization, what will be the collateral, and so on. And these bonds will be exclusive to Wint Wealth.
Right. Okay. Okay. So we might come back on the product, but I now understand what the product is. Let's talk platform now. Right? These bonds are available on your platform, and I started with saying what was a hard problem. I also saw an interview where you kind of actually made a list of all the hard problems. I think it's about 100 odd problems you had come up with, and then you chose this one. So talk us through, why was it a hard problem to solve and how you solved it? What is the crux of the platform?
Yeah, I think like it is hard because to ask a retail investor to invest into a new asset class is hard, right? Why should he invest? Why is this asset class good? And because
we'll talk about the retail side, another thing, but on the supply side, in terms of making these bonds available on a platform, like where is the technology part in the platform? So let's talk us through, perhaps maybe start with the regulation aspect, like how did platforms come about? And it's not just you, I think there's about 15 odd platforms available now, right? So why did they all come at the same time? What was happening at that time which sort of brought this about?
Yeah, I think the core reason at that time FD rates were very, very low. So people were desperately looking beyond FDs.
Which year was this?
This is when COVID happened. So this is second half of 2020 or first half of 2021.
Okay.
The low interest rate regime.
Okay.
So there was a pull in this category. Second, supply was never a constraint. I mean, in fact, if you look at these NBFCs which we work with, right, they want access to retail capital. Today, their main access of capital is either institutions like banks or like large NBFCs or mutual funds. Post ILFS crisis, I think mutual funds segment as a supplier also became very sparse. So they want a diversified source of capital. And today, bank exposure to NBFCs has gone from about 5% 3-4 years back to about 10%, right? So banks have certain limits saying we won't lend beyond this. So if NBFC has to grow, they want capital and there is no source of capital. So they wanted retail capital. Just that there wasn't any platform there wasn't any platform to get retail investor to subscribe these bonds in a very ethical and educative manner, right? And it becomes troubles because these NBFCs are good, right? If you're an insider, you can probably take a look and say these are far less risky than bunch of these NBFC. You can certainly have, like we have one kind of system where we gatekeep NBFCs, and then we have risk profiling, etc. But how would a retail investor know, right? These NBFCs are not Mahindra and Bajaj. They might have a fantastic financial health, but how would retail investor would know, right? And because as Anshul mentioned, right, if their rating is low, like how do you know these won't default, right? If it is a rated NBFC or AAA rated NBFC. So there was this gap saying, how do you tell retail investors, like, if you need this product, probably this is a good product. This has, obviously the risk is higher than FD, but this is how the risk is managed. And probably this is a good product for your portfolio, right? So you have to educate them. You have to build trust on the platform, saying these are not fly-by-night operator, right? So the crux, I think, the hard problem was solving it for retail, not per se supply, because I mean, Anshul was syndicating the same thing in his previous roles. There was always supply available, right? And these NBFCs were ready to pay some premiums to get retail in, because retail is the most sticky capital, right? And second, we only work with private PE funded NBFCs, private equity funded, right? So they have IPO ambition at some point of let's say 4 or 5 years, right? And if they get bondholders, retail bondholders, who invest in these bonds, hold up these bonds for 2-3 years, repeatedly invest, get interest, the kind of trust they have in the NBFC, the kind of brand value it creates is unparalleled, right? It's the proof of work, right? Rather than saying this NBFC is good, they have actually tracked that NBFC for 3 years. So there was a pull, there was this, but there was you have to educate retail investor, you have to get the right kind of bond structure that will appeal to retail, that's good for retail, get it on the platform, then educate retail investor and get them, and you have to do it at a very cost efficient way, right? So that was the hard problem.
Okay, so a couple of things there. One is building trust with retail investors and educating them, and then there was also, I guess, the fact that platforms were not regulated until recently, right? Which is where SEBI sort of stepped in. So talk me through what happened there, like how many platforms came about. So yours came about, obviously, but there's a few others. And then why did SEBI step in?
I think there was suddenly they started for a long time there has been this mandate saying if India has to become a developed economy, the bond market has to go deep, it has to have a retail partition. These businesses are not AAA rated, let's say A rated and BBB rated businesses need to have access to a retail bond market so that they can grow, and that will eventually push the economy further, right? So there was always this mandate per se saying, or there was always this will of regulator and regimes, governments, etc. Ki the bond market has to deepen, but it hadn't happened, right? And after 2020, we came up, bunch of other platforms came up, and suddenly there was activity, right? And unfortunately, there was some mis-selling happening also by some platforms. Right?
What
So
was the mis-selling aspect? Like what was going wrong?
when you if you look at Wint Wealth, right? When you click invest now, we show 3 risk-related screens.
Right.
So in a financial product, risk is a part of product, right? It cannot be in a footnote or something that runs at a 3x speed saying this is subject to market risk, blah 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 blah, right? You have to educate, right? So we have 3 screens. Some platforms are saying this is FD replacement, this is liquid, this is low risk, right? And even for unrated NBFC, forget investment grade, right? Unrated NBFC where no external rating agency has even judged. Now, you might have different opinions, right? When about a rating of a NBFC, but if rating agency hasn't rated it, right? Then how do you know even whether that data is? There is no third party check that has happened apart from.
So they were basically listing NBFCs, unrated NBFCs or higher risk
not even
NBFCs.
Listed. At that time, unlisted bonds were also okay, but
sorry, they were on their platform. They were giving names of NBFCs or bonds or structures that were not rated and not highlighting the risk.
Yes.
That was the major
saying
issue,
it is replacement of FD, low risk FD, guaranteed liquidity.
Right. Okay, so given that you are doing the curation, you're doing the research and you're pricing and saying this 9 to 11% yield is a reasonable yield, you were doing some sort of investment research. So SEBI stepped in and said, therefore, these platforms should be regulated.
Yeah,
right?
so SEBI's idea was, their idea was not per se platform. They're saying, okay, finally the bond market is getting deepened.
Okay.
We must make sure that only serious players remain and they operate fairly so that nothing goes wrong. Because anything goes wrong, then you've gone 2 steps ahead and then 5 steps back, right? So there, and even the regulation, which was pretty progressive, helpful for the platforms. They listened to us well. Idea was to make sure that while it is nascent and it is taking off, it gets regulated, so only serious players remain.
Right.
And they operate on certain fairness and they don't mis-sell, right?
Right. Right.
And it was a very great move.
So that was in November 22, the
Yes.
circular came out, right? 14
Yes.
November. So now, how many, so what is the regulations? They're called Online Bond Platform Providers, right? OBPP, right?
Yes.
How many are there?
I guess about 20.
So just in that space of 6 months, 20 of these have been licensed.
Correct. Yes.
Yes.
Right. Okay. So, okay. What does that mean? I mean, I noticed that there's still a risk statement. Investments in fixed interest are subject to risks. So they've dropped the word market compared to mutual funds,
Correct.
which was kind of interesting for me. And then read all of your documents. So you have to provide, I think, the rating sheet as well as the information memorandum. All of that you have to provide,
Yes.
right?
Yes.
Okay.
I think we do far more disclosure.
Yes.
I'm not sure about the baseline disclosure.
Okay, so just that's all you have to provide on the platform. What else? Just sort of diving deeper on the tech side. What else, from a technology point of view, happens behind the scenes? So, like, I mean, you have a stockbroking license, right? So, how does the buying of bonds happen compared to, say, buying of stocks? If you could just spend 2 minutes on that.
Yeah. So they have proposed a different flow. It's not operational yet. So we still operate like we do OTC transactions. So user pays us to payment gateway and we transfer the bond units to him. So our broking is not operational yet. It should get operational soon. We just got to the license 1 month back, right? But how it is supposed to happen is there's a new flow that they're testing wherein saying, let's say you come to OBPP, you punch in the order and you get a payment link of exchange. So money doesn't actually flow to OBPP. You pay the exchange through payment gateway and that money directly goes to exchange, right? So that's the difference.
The exchange being?
NSE, BSE.
Right.
Right. Right. So,
Clearing corporations of these exchanges.
clearing corporations.
Okay.
Yeah.
Right. Right.
So.
And you can pay by anything other than UPI and stuff I can use to pay?
Yeah, everything is allowed. So the risk they are eliminating is the counterparty risk.
Right.
When the customer directly pays to the broker, there is a probability that the broker may not honor the other side of the trade.
Right.
But by introducing these clearing corporations, what they're saying is you pay money to the corporation, broker will transfer money to the broker will transfer the units to the clearing corporation, and then thereafter the two sides of the trade will settle. So the counterparty risk of the other party not honoring their side of the trade gets eliminated.
Right. And depositories and all of that
Yeah,
is
all
also
these like are
right.
listed units. The units come in your demat account, similar to how a stock works.
Right. And just in that whole process, the whole unlisted bonds also has been eliminated, right?
Correct.
Through
Yes.
this licensing.
Correct.
Yes.
Which until this November circular came out,
Was
there were
allowed.
unlisted bonds also available in the
Correct.
market. So what happens to them? What happens to the unlisted bonds? I'm just curious now.
So SEBI's nudge is like the entire bond market should shift to listed bond market. Another regulation they have introduced is like, let's say if a company has done a listed issuance, now a company cannot do any unlisted issuance whatsoever.
Right.
So gradually SEBI is nudging the entire bond market to shift towards listed issuances only in the interest of transparency so that there is no mis-selling, etc., which I think is the right direction.
Okay, so now let's look at the education sort of aspect. You said that was the hardest problem. And you're also forming an association of these platforms, right? Is there a plan to shift the education to the association like what has happened in the mutual funds or in the PMS scheme?
It's still a very nascent association. It will evolve. Maybe like sometime in future, either the industry will like decide that okay, we'll contribute this much money to the association for educational purpose, or SEBI might like put a direction. But I think like over medium term, both the things will continue. It's not like a mutually exclusive thing that only the association will do, not the industry.
Right.
I think industry.
But
will
there's
also
no
do.
sort of, I mean, do you get together with other platform players and saying, okay, you know what, your education piece here seems to be a little bit on the nose? I mean, is there some sort of mechanism?
No, so far not. I mean, like the body is in the process of forming. It's not been like formed yet.
Right.
On Monday, we are having our like third meeting this coming Monday. We're in the charter.
But you all know each other.
Yeah.
Pretty much. Right. So let's talk the education aspect. So Ajinkya, you and I were on the same top voice list in 2020.
Yes.
At that time, you were called something else, Grow Fix or something,
Yes.
right? So tell me more about that. I mean, did you have this pre-decided that you want to become an influencer or be visible on social media, and then that would become the trust factor?
Not really. I mean, in fact, very interesting. That was not the aim. So we were supposed to launch in April 2020.
So you already were working on this idea for a while.
Yeah.
Right.
So I started working on this in January. Of
2020.
Yeah.
Okay.
So and I wasn't writing anything on LinkedIn back then. So we were supposed to launch in April. So in March, COVID happened. So everything became to halt. So we wanted to do one pilot, so get it rated, everything, and we were very clear that it wouldn't happen for 3-4 months. Like, we are sitting idle, and we wanted to talk to customers, figure out what they like, what they not, just understand customers. And that's where we looked at LinkedIn as a way, saying, I have so many connections, and those are potential customers. So let us understand this market, and probably writing was a way for us to get in touch with our customers. So it was not to say, let's increase visibility, or let's say build a funnel for Growfix or Wint, right? It was just to say, let's write this and we'll see how it goes, and can we understand users more. Okay. So what are they interested in? Not just about bonds, but what are they interested in? What are their problems? How could you help it? Right. So what we knew from start, and this from consumer angle, saying if you know your user really well, you are most likely to succeed, right? So that was the idea.
Right. So
we started writing, and suddenly picked up people. We started getting a lot of DMs saying, can you write about this? Can you write about this? Can you write about this? So we started writing, and then that became like front. But it wasn't very planned, saying this will create. It did create a lot of impact for Wintwell, but it wasn't the aim actually.
Right. So who is your user? You started saying that your connections could be potentially users. Who is your target customer?
So our target is basically someone who has. So we do say retail, but if you want to invest in fixed income, you have to have some minimum kind of disposable income. If you are just investing 400-500 rupees a month, or let's say 1,000 rupees a month, then mutual fund, plain vanilla mutual fund is the best product, right? So how we look at our user, it's somebody
mutual fund, what? Equities, debt?
Yeah, equities, or like if you want to park money in fixed income, FDs are, right? Because by investing that money, you generate some 2% extra return that doesn't anyway move the needle anyway, right? So from a very customer point of view, is when you have about 10,000-20,000 of investable income per month, that's where our segments start, and that translates to an income of about 5-6 lakh and above.
5-6 lakhs a month?
A year. Yeah, I'm talking about 10,000.
No, 10,000 rupees per month, you're saying?
Yes, saving.
So
investing.
So basically they would be earning 50,000 rupees a month.
Yes.
And saving, say, 10,000.
Yes.
20% of their income.
Yes.
And they are your customers, you think?
Yes, that's a starting point. From there to about someone has 70-80 lakhs of yearly income. Above that, they generally have access to a financial advisor, either mutual fund distributor, RIA, or some kind of a personal touch model. And that's not a segment we cater to. So we were very clear that we want to basically solve this problem using tech. So this is the band we operate in, right? That's our target segment.
And private wealth customers have access to these similar sort of bonds through their private bank.
Yes.
Right. At a 6 lakh income, what is wrong with debt mutual funds if they are sort of in their short term, in the 1 to 3 year saving sort of market? What is wrong with debt mutual funds?
No, there is nothing wrong in debt mutual fund.
Why should they not go there rather than coming to you?
Yeah, because if you have that 5-6 lakh income, tax indexation or like getting a tax benefit out of debt.
But 6 lakhs में क्या tax देंगे यार?
नहीं होगा, मैं वही बोल रहा हूँ.
Exactly.
अभी तो इंडेक्सेशन भी चला गया, बट पहले भी तो why like debt, and if you look at debt mutual fund, they're at the range 8.
I was slightly like extreme opinion here. Like rather than investing in debt mutual fund,
FD is better.
FD में invest करो. The debate should be कि FD or bond, like why should one invest in bond and not FD?
Because अगर आपको debt mutual fund में भी 8-8.5 ही मिलने वाला है.
हाँ. So that's my point. So everyone knows FD. So the first thing everyone does, including me, I'm sure your parents, and in fact that's how you started, right? I think you parked your money with your dad, right?
Yes.
That's how it started. But I'm just asking, so at what point should a retail investor look beyond FD? Like, what is the income, or what is the problem statement? What is exactly, why should they look beyond FD?
Yeah, how I look at it is whether it suits your. So how I look at personal finance as how do you invest money? How do you choose which asset class to? It basically on time horizon you are open to invest, right? If you want money back in 6 months, it is kind of as good as emergency. So you park it in any very liquid, right? Either an overnight fund or a FD, right? And you don't think of returns. If it is beyond 5 years, probably equity is the equity, either stocks or preferably mutual fund is the way to go. Now, 6 months to 3 years, it's something that you could, if you are okay with risk, but you still cannot go in equities because that could erode the capital in short term. Right? That's where this is a good asset class to invest in, right?
Right. Even for like beyond 5 years, I don't think like someone should be investing 100% of the money in equity.
Right.
Fixed income should be there. Like one can debate whether it should be 5% or 50%, but that amount, the diversification need is like genuine.
Sure.
I mean, we have seen China like in 2 decades, the equity market has given 0% returns. Unlikely something similar will play out in India, but one can never say. After all, equity is an uncertain and volatile asset class. So you can't be putting all your eggs in the equity basket.
Right.
You need to have some kind of diversification, have some allocation in debt. Within debt, diversify, like have FDs, debt mutual fund, bonds.
Why? I mean, I'm getting exposure to the underlying debt asset class. Okay, FD I can understand, but after that, why should I buy a debt mutual fund, which already has X number of securities in it, as well as directly? Why should I do that?
No, debt mutual fund doesn't make sense for retail investors.
Why is that?
Because you take risk, but there is no premium.
Debt mutual funds, the average yield is 8% pre-expense. Expenses are in the range of 25 to 50 basis points.
And why is that? Because they have to invest in a certain
They're conservative.
rating.
They don't go below AAA.
Why is that? They are the sort of credit risk funds as well, right?
You look at the YTMs, which is the yield of the portfolios. There is no debt mutual fund giving more than 9% pre-expense yield to the investors.
Again, I'm asking, why is that? Do you think there is a category that needs to be there for that? There is one, right? There is a credit risk category that's supposed to be solving exactly that, right?
Even for credit risk, post the Franklin fiasco, all the mutual funds have become like very, very conservative. No one wants to go even below AA category.
And that's my point I'm asking you. Why, if a professional qualified fund manager is not wanting to go beyond that and you are going there, that's exactly the point I'm asking. And that's one. Second question is, I've heard you say in interviews, you should have 10 bonds. Okay, I understand 10. But 10 is an arbitrary number that you've picked. I'm sorry, but any CFA textbook will tell you in bonds you need to have 300 names. Because you need to have no more than 3% allocation to a single bond. Because in bonds, unlike in stocks where you can have 10, 20, 15, 20 stocks, where after which diversification sort of levels off, in bonds that's not the case. Okay, you do not ever want to have capital sort of loss. Therefore, you should have 300 bonds. So my point is a retail investor can never get to 300 bonds on their own, right? They need to go through a debt mutual fund. So the question I'm asking is philosophically, why should a retail investor consider buying bonds directly, taking that extra risk rather than going through a debt mutual fund?
Yeah, the debt mutual fund part is the question, like after Franklin, a lot of things have changed. First is nobody wants to take the risk, and if you go for higher yield bonds, right, you have to accept that at some point of them, they will be liquid, right? And that's what actually killed Franklin Templeton. In fact, we are looking, most of the money is written. I think none of their actual bonds are actually defaulted.
The bonds have defaulted,
but the money came back.
Money
right?
came back.
Yeah. Right. So money wasn't lost. It was what killed them was liquidity. So the problem with credit risk mutual fund, and at one point of time they had AUM of about 1 lakh crore, and now it is about 25,000 crore, just 1/4, right, or 1/5. The thing is, they were sold as replacement of FDs again, sold as completely liquid, right? So you could withdraw anytime, right? And when Franklin happened, Franklin also lost half of its AUM in equity mutual funds. Right now, so no other mutual fund wants to be there and take that risk. So they've gone all conservative. So if the pre-expense yield is 9%, and if you remove 50 basis point, you are at 8.5, which is a small finance bank FD gives you.
It's not even 8.5. Like for credit funds, the expense is in the range of 100 basis point, and the highest pre-tax YTM is in the range of 875. So net of expense ratio, you'll be getting sub 8% yield.
And plus you carry risk. Right. Then if you are taking risk, you should have some premium, right, attached to it. If there is no premium, then you should not invest, right?
Okay. Which leads me to your business model. Okay, so if we're paying 100 basis points to a debt mutual fund and therefore it negates the alpha that they're generating, how does a retail investor sort of pay for the service that you're providing?
Yeah, we make about 1%.
The same 1% that a debt mutual fund makes.
Yeah, actually, we even if it is a 2-year-old bond, we make about 100 basis point only. So it is about 70, 80. It will come to about 70
basis point.
Yeah,
And that the issuer pays.
Either issuer pays. Like in my mind, it's just that generally the customer pays. It's just that you're not asking him money.
But technically, every product is like that. Every product is where, but it makes a difference who pays because your allegiance lies towards that party,
No, many
right?
times we sell the bond at a higher price. So in many cases, NBFC has paid us zero capital, zero fee upfront, and we have sold the bond probably 100 rupee bond at 101 rupee, right, and made our money. So the XRR you see on the website is after all our fees, and sometimes the bond are priced at a higher price so that we can make our fee, and we are very transparent. So it is the customer paying. So our allegiance is to customer, and we are investing in the bond and holding. We invest 2%. We are the largest investor in any bond issue and hold till maturity, right? So that way we are sorted. After that, we are providing 10% yield, right? So even when a bank provides you yield, it's after all our.
Yeah, but the bank takes balance sheet risk, right? I can assess the bank. Here, the money is never going to you, right? The money is being invested in the underlying NBFC. You are taking 1%, and I can never hold you accountable, really. Can I? I mean, if some bonds blow up on your platform, probably your platform will be sort of gone, I guess. But it's an indirect way. I have no direct recourse to you.
Correct.
Yes,
right?
yes.
That's kind of you are. Now tell me, you keep saying you put 2% of the issue yourself from your balance sheet. How big is your balance sheet and where did that money come from?
It's mainly from equity that we have raised, right? And slowly, like as we grow, we will probably raise debt to invest.
How much money have you raised?
We've raised about $20 million, so about 150 CR.
Okay. And how much of that is being used as sort of...
So we have about AUM
about 20 CR.
Yeah.
So we have sold 1,000 crore plus bonds. 2% skin in the game is what we carry. So 15 to 20 crores is what we are holding.
And therefore, how much revenue have you made?
I mean, 1% is our average. So 1% of 1,000 CR.
Right. And what sort of margins, like what is the other expenses that you have on running that? So therefore, as a business, if I were to want to invest in Wint Wealth as a platform, what sort of economics sort of you
I think if you look at just underwriting ATC, that cost comes around 20 basis point on a scale. Obviously, we haven't scaled, so it will be higher for us. That is kind of a fixed cost, not fixed, actually variable cost as we scale. That will be about 20 basis point is what we have estimated. The second major cost is acquiring customer, right? And like that's where the cost. If you acquire a customer at a lower price point, then the unit economics makes sense, I think.
Coming back to acquiring the customers, so is there a CAC that you calculate?
We do.
What's that?
It's about 1,000 rupees currently. When we are scaling really fast, it was about 1,500, 2,000. And as our more organic channels start firing up, the CAC would come. So we want to keep it below 1,000 rupees, and we make sure that we generally look at it how fast it is getting recovered. So generally we want to be at a price point where it gets recovered in 6 months.
You compare it to LTV? You compare it to lifetime value?
So LTV is a very theoretical concept, right? We do track.
We're talking VC jargon here now, right?
Yeah. We do track LTV. Historically, how people have invested, etc. And obviously, as we bring more products, the LTV is gonna go, right? And a good way of looking at LTV is if your NPS is high, your LTV is definitely going to be high as you start cross-selling, right? But in general, we don't want to be in a situation where our existence depends on the next round. So therefore, we have kept it very simple, saying CAC has to be recovered in 6 months. Right.
So coming back to this sort of investor education piece, or let's link it to your marketing funnel. So where do you get your customers from?
I think.
What's the split?
Yeah. Initially, we did a lot of work. Like a lot of customers came from my LinkedIn. Right. Then we worked definitely.
Did you qualify as an influencer?
No. Like I just.
What is the definition of an influencer? I know that
you need to have more than 1 million followers.
Is that what it says? It doesn't say that in the paper.
It says.
Oh,
so if you are there is no definition of
There is.
influencer.
No, there
Which
is,
means,
there is.
does Nitin qualify as an influencer?
Oh yeah.
He can promote Zerodha. He cannot promote.
He cannot promote you.
Does he have like more than 1 million followers?
Yeah,
he
he's
has
reached 1 million, yeah.
Yeah, 2 million.
On LinkedIn, is it?
Yeah.
Yeah. So he's a influencer.
So he can't talk about you. Great. Okay, sorry. So coming back to this, we'll talk about influencers, but just
So
finish
he can
that
talk
thought.
about. He cannot charge money for talking.
I mean, like, organically, like even like normal influencers, they can promote anyone, but we
They
can't
cannot
pay them.
make.
You can't pay them.
Yeah.
Right.
So I have only 1 lakh followers. So I'm not.
So Nitin can.
I
pay
can't
to
talk
promote
about you.
Zerodha.
Ajinkya, I can't talk about you. I have more than that.
Oh, is it?
Actually, I don't have million, but I don't have million, so I don't.
They're not paying you as well.
That is also true.
Right, yeah.
So then,
Yeah. So we did bunch of work with like reputed influencers. Right.
who's the reputed influencers?
So in fact, like that's a very good debate too. It's a very
Yeah,
hot
let's
topic.
talk about that. I mean, what qualifies?
So,
Like, what qualifications do
Let
they
me
even have?
Yeah. No, I don't look at it from qualification point of view. I mean, I do think that there should be a regulation and someone to promote any kind of content, they should have some education. If not any formal degree, probably some NISM certificate should be made mandatory. But like I look at influencers in 3 categories, right? First is which is the most shady as a category is people who share P&L screenshots, right? And then sell courses basis of that, right? Then second is the 4-5-year-old influencers who were mainly originated on YouTube and they scaled YouTube, right? And then there is a new gen, which is third, which came post 2021, which is Instagram, right? In their origination was Instagram. Obviously, once they scaled, they came across. They basically tried to diversify across all platforms. So we did some deep work with especially people on YouTube, right? And not the and unfortunately we did end up working with these P&L guys also because we were also new, right? So we didn't know who's good, who's bad. In fact, I don't come from a wealth tech background, so right, I actually come from a lending background. So we didn't know. So but we did a bunch of work with these YouTube influencers, right? So a lot of traffic came from that, and then referral became our referral, and generally organic became our
Referral from other existing customers.
Yes, 40-50% of our customers come from referral.
50%.
Yeah, okay. 40, like little less than 50, but
Okay, and the other balance comes from influencers still.
Not.
Do you have
not,
advertising as a channel?
We did try, but we decided we don't want to do it. So we don't do any paid advertising. We might do retargeting, or we have to bid for our own brand keywords.
Right.
So if somebody searches Wint, we want to we have to pay Google for. Lot of it is organic, right? Word of mouth, which may not be tagged as a referral, but eventually it is someone like some existing investor of Wint talking about Wint, right?
So to what extent does this philosophy sort of tie in with your investment from Rainmatter? I mean, you have other investors as well.
Yeah.
Do they not give you targets that you have to grow at a certain rate, and therefore you should invest money in customer acquisition?
No, we were very clear saying we cannot have targets like that, because once you have these targets and very hard-coded targets, you eventually start mis-selling, right? Because I mean, incentives decide how you. And early on, and we were very fortunate to have Zerodha investment, not just for the money, but like we could see how Zerodha operates from inside, how customer-centric they are. Especially in this industry, you cannot work like any other industry, because you are essentially asking people to invest in products, and their hard-earned money is investing. You are not selling some consumption product which is feel-based, want-based, etc. Right? So that did shape our early sciencing. In fact, I've spoken this before when we launched Wint 12, or back then it was GrowFix. We said this is low risk because we thought it is low risk, right? And first
For
day,
whom? For the
customers.
Achha,
Right? Right?
You said that on your website?
Yeah, we wrote
low
it.
risk. Achha,
Right?
okay.
Yeah.
Okay. And then?
And we had a lot of, like, on day we launched, we had about we had the first asset of about 10 crore and 70-80 lakh was sold on first day. And we called up these customers and understood nobody's understanding risk. And obviously we said it low risk, right? So they believed, right? And then we spoke to, we happened to spoke to Deepak Shenoy, and he said, FDs are low risk, this is high risk. You guys are doing a decent job, but this is not, like, don't miss-sell. And I couldn't sleep that night, so overnight we changed the website, said this is high risk, this FDs are low risk, this is high risk. And we called every other customer up who had purchased and saying, we said it's low risk, but now we understand it's high risk. Do you want to exit? And we are free to offer you exit, right?
Acha.
And some of them did, right? And then the flow came down. People started investing less, right?
But on the site, you don't say it's high risk per se.
We do.
Do you?
Yeah.
In fact, like each time you do an investment, there are 3 nudges which come up. First nudge is, and these are like blatant, in your face kind of nudge, which pops up.
In fact, it's a
replace.
toggle. Basically, you say, I understand. And you click on that. Then only you go to the next stage.
I spent an hour on your
Did
website
you do
yesterday.
the
I
investment?
didn't get any such thing.
Did you do an investment?
No, but I spent time to, I mean, I would
No,
have.
if you like go through the investment flow, there are these 3 pop-ups which come, and you need to click on the toggle to proceed. First nudge is, it's not a replacement for FD. Hence, don't park your emergency funds here.
Actually, that I saw somewhere. Yeah.
Second nudge is, these are high risk investments. Third is diversify. If you want to invest one, don't do it there. Like you need to diversify.
And in FAQ also, we have mentioned that this is high risk product. FDs are low risk.
I put my number down for your FD waiting list.
Oh, okay.
So let's see what happens there.
Yeah.
It's not the same number that you have, so therefore you can't track it.
We don't track it anyway.
Right.
And,
Right.
and in that process, because Nitin was there, it did create very soft influence of how this working of this industry is and how people look at it. And early on, we realized, I mean, the retail investors are so prone to mis-selling, right? Even if you tell them there is a risk, if they want to hear there is no risk, they will hear no risk, right? So you have to take that extra care of communicating very, very clearly.
So you were saying that Zerodha being an investor, or Rainmatter being an investor, had a soft influence on the risk part. So just make me understand, coming back to the starting point, the psychology of the Indian retail investor, do they really understand risk? Because when somebody rattles off mutual fund are subject to market risks, I mean, I know they're supposed to say it slowly now. Do they understand the word market risk? Do they understand liquidity risk? Do they understand credit risk? You saying that it's high risk and then listing off all the risks, does that really work? How do you know that they understand?
Yeah, so we have tried to make it very simple, and we basically call out the risk, saying this is the credit risk, this is the fraud risk, this is the liquidity risk, and these are the risks. And we try to explain it in as simple terms as possible. They do understand. If they've read it, they do understand. What I often doubt is whether like they understand the repercussions well. Like we have often customers coming up and saying, we want higher yield bonds. Why are you just bringing 11%? Bring 13%. And we tell them, there is very high chance of them defaulting. We are okay with it. We just want 13%, right? And from previous example, at least I know that like they will not be okay, right? Wherever defaults have happened, they are not okay, right? So when you ask people, like especially on Wint Wealth, and we have done this, like we have to check this, like whether people understand risk. The answer is yes. Can they explain risk? The answer is yes. Like not in like really articulated manner, but they will tell कि इसमें थोड़ा ये chance है FD से other risk, because it is clearly called out there, right? But when it happens, are they prepared emotionally for it? Not really sure, right? And that's across not just for bonds, that's across all the investment that they make, right? Everybody knows that you should not stop SIP, but still people make this, decisions. If the market has fallen so much, I'll stop SIPs. If the market is all time high, I'll stop SIPs, right? So and these are, I'm talking about very educated investors, right? Who stop SIPs and try to time the market. When they fundamentally know it is very hard to time the market, etc.
So there are a couple of things there. One is the emotional pain, which any loss, I'm sure even you will feel it when you experience it. But two is being wiped out from it. So what happened in the Templeton case and a bunch of other cases when I see things blowing up, there are always some people where they put their lifetime savings into that one thing. Now, to me, no matter how good the product was, there's no way I'm putting my lifetime savings into anything, right? No matter what people say. How is it that people still end up doing that? So how do you counter that? I think high yield with high risk is okay, provided people understand, and at their end, they've diversified.
Yes.
There's only X% of their portfolio into that thing.
Yes.
They'll still feel the emotional pain, they'll still blame you, but they won't get wiped out.
Yes.
How do you or is it your responsibility as a product provider, as a platform provider, for you to cater to the fact that they are not diversified?
Legally, no, but morally, definitely yes, right? And we do that. In fact, earlier we had like, even today, if somebody invests really high amount of money, we actually call them and saying, do you understand this, right? Do you have any doubts? And I can tell you one example. There was one lady who came in and she saw these guys are, Zerodha is invested in these guys, so these guys must be good. And she invested 50 lakh in one bond, right? And we called her up and said, okay, how much do you plan to invest? And so she said, I want to invest about 1.5 to 2 crore. And said, then you probably should not invest 50 lakh, right, in one bond, right? And you should diversify. And she said, there are no other bonds available. We said, okay, take out the money and when the next bond comes, you can invest, right? And obviously we can't advise. So once we become brokers and once we have some legal standing, I think we can do this much more aggressively. But we are just saying you should look at this webinar, and if this were my money, I would invest in like this. And she actually ended up withdrawing 30 lakh. I don't know what happened later, whether she invested or not. But we do take such measures. But yes, as an impulse, retail investors don't understand and they don't diversify well, right? So like we often see customers saying, we will not invest in 10.5% return wala bond, but we will only invest in bond which has 11% or higher return, right? Right, and they wait for that bond and they will suddenly put a lot of money in that one bond, and we called up, but unfortunately we are not able to change that, right? In fact, therefore we are working on this one product saying, like Anshul can briefly talk about it, is we are basically bringing a securitized debt instrument where underlying there are 20 bonds, 30 bonds. So even if you invest 1 lakh, that amount will be diversified across 10, 20, 30 bond, and eventually probably more, right?
Okay, how does that work? Are you taking on principal risk?
No. So it's like a bond,
Right.
which in turn is backed by 15, 20 underlying bonds. So even if, let's say, one out of those 20 bonds were to default, only 5% principal will be at risk.
So what are you doing, and what is the minimum for that?
1 lakh.
So if I put in 1 lakh, are you splitting it? Is it a technology solution that you're splitting it, or is it the wrapper?
It's a new security itself. It's a wrapper.
So it's like a basket which is there, and then each basket will have like different underlyings.
But is a basket a security?
Yes, it's a security.
It's a legal security.
It's a legal security.
What is the structure today?
Listed, rated, and SEBI has a defined regulations introduced way back in 2008. Some transactions in the institution markets have already taken place. To the retail market on our platform, will be bringing mostly in October.
Okay. How is that different from a mutual fund?
So 2-3 nuanced differences. Like in mutual fund, you are outsourcing the decision making to the investor. That here is my 1 lakh. You take a call, maintain my portfolio, keep on churning it. It's not a static portfolio. In this case, it's a static list of those 20 bonds wherein you are investing, and the underlying remains static. You can't churn it. No one can change it.
I think mutual
So
fund
like a basket, like a
Yes.
small case
Small
type
cases.
thing,
Correct,
right?
correct,
So
correct.
where
And each basket will have like different underlying. So you can pick and choose, okay, I'm comfortable with these 15 underlying bonds and not these 15.
will the investor choose the whole basket, or will you give pre-made baskets and say pick one of them?
These will be pre-made baskets. Investor can choose, I like this basket and not this basket.
Another thing in mutual fund is they have sectorial caps, right? So if you see good yielding products for similar ratings, NBFCs will provide that. But unfortunately, I guess mutual fund have sectorial caps. They can only invest 25% in one sector, which is NBFC. Now the market is 70 to 80% NBFC, right? But in mutual fund, you only get 20. So yield is suppressed. Again, in second, mutual funds have to have about 10% as liquid holdings, right? So that also suppresses the yield. So that is the fundamental difference. Obviously, the liquidity is going to be higher in mutual funds. It is going to be very well diversified if you look at sectors, etc. But here also, eventually we'll bring in NBFC sector, corporate sector, government, like some kind of, all these kind of baskets. And we are asking regulator, and in fact we are urging them, saying the ticket size has to be reduced. And when this regulation came, the SEBI chief person had said that they will reduce the ticket size further from 1 lakh eventually. We don't know when, but we are hopeful, right? So at a lower ticket size, higher diversification. But I agree fundamentally when you said there should be 100 bond. So from a retail investor perspective, there are two backstops that I see. You are essentially getting a 10% yield. Your FD is at 7.5 or 8. Then you want to make more than FDs. Then you will be happy, even if there is a default. Right? That means if there is a 100 bond portfolio, 10% yield, then even if one bond defaults, you're okay. Once 2 bond default, you're slightly less than FD, then the pain starts. and if you actually lose more than 10 rupees and the actual capital is less than 100, then people have really like the amount of pain, emotional pain increases a lot, right? So I think if it is well diversified, and which is where eventually we are moving to, it should be enough bonds that even if one bond default, you should actually make more than FD return.
Right. I'm glad you didn't say that. Actually, in one of the interviews, you did say that mutual funds also have the sort of mark to market.
Yes.
Sort of issue, you called it. But is that an issue? I mean, in a way, it's teaching investors what mark to market is. When all the risks say mutual funds are subject to market risks, they have to understand that mark to market is simply them marking their portfolio to that day's price. They don't have to sell at that price, right? But I know that there is a perception that debt mutual funds somehow are riskier because they're mark to market. Any thoughts?
I don't think there is such perception. In fact, if you look at our investor, 95% of them have never invested in debt mutual fund except liquid mutual fund, right? MTM is very complex as a concept to learn. That's the whole problem. I'm not.
But is it? I mean,
it's very
saying that
it is very complex for
not for three of us, but if we like go and understand the retail investor psychology, for them it is.
Even if you explain right to them.
Is that why they come to a bond and try to hold it to maturity? Because they're basically, no one is telling them today your bond is worth less. No one is telling them, so they don't know. It's like saying, I'm living in a house, my house is worth 1 crore. Now, if you come every day, knock on my door and say, it's worth 80 lakhs, it's worth 50 lakhs, it's worth 1.2, I'm going to freak out. That's what the market is doing. Basically saying today your house is worth.
To a certain extent it is, because like that's why FMP as a category like really picked up compared to other categories of mutual fund. That's why FDs is like 50 lakh crore, while retail investment in debt mutual fund is only 40,000 crore, less than 1% of where the FD market is. People want that certainty in a fixed income product, that you told me I'll get 10% return. If I hold it for 2 years, I better get the 10%. Then don't tell me the rate moved up or down. Now I'm getting only 4%.
So it is this, I'll hold to maturity and therefore I'll get the return that I was promised. Right?
That's the expectation from a fixed income instrument.
Now, technically, investors all over the world should be the same. Why is FMP an Indian thing and doesn't happen elsewhere? So I'm asking, do you have any insights for a foreign investor, for example? Is there anything inherently about Indian investors? And perhaps it's just because of what we had available, because of our interest rates, because of our upbringing. I'm just asking you any insights that you have about Indian investors that makes FDs, FMPs and products like this more suitable.
Like investors could be same, but how the regulation and whole ecosystem of how we have cooperative banks, NBFCs, which may not be present there, right? And in USA, municipal bond is a very big thing. In India, they're not, right? In India, we have also seen state development bonds defaulting, right? So that ecosystem is completely different. So investor has to react very differently. It cannot be someone like an American investor, right? We have till recent past, 1-2 decades back, a lot of offline things were very prominent. Great cooperative society providing high trust investment, high yield. So the ecosystem is very different. So you can't really compare the investor to investor just because the investor is same. What in front of him is completely different. I don't know about I know little bit about USA, but not about other markets.
I think it's also a matter of time. So I don't think fundamentally, psychologically, this behavior cannot change or will not change. It's just that in India, traditionally fixed income has been about FDs, and FDs by design, they give you fixed returns. If you withdraw before maturity, you pay a 1% penalty and get the money. That's what we have seen our parents do. That's how we have been brought up. Once the debt mutual fund bond market starts percolating down, I think the behavior may change.
Even the delta between FD and equity was very low for a long time, right? In FDs, in equities, if you look at mutual fund, you can assume 11-12% return rate. It could be higher, but you can. For a long time, FDs were, even bank FDs were 9, 10, 7, 8, right? While if you look at US, the equity will give you about 12, but the FDs are 1%, 2%, 3%, 4%. So the higher the delta, the easier to change that behavior, right?
That's also slightly scary to think that they expect 11-12% without linking it back to GDP and so on. But yeah.
Yeah, I kind of agree with you. I think equity as a concept has been like oversold to the equity believers, to the extent like people are now like looking to take leverage to invest in equity. So you have these two extreme persona. One persona doesn't like equity at all. The people who like equity, they want to go all in into equity as an asset class.
Yes, in fact, I met an investor who said there are 100% portfolio equity mein.
They assume that 12% is
You know,
Yeah,
okay,
and
here's the other thing. I mean, when they say 100% of the portfolio, that's not of their wealth. They will still have their house. They'll still have some FDs. If not them, then their family will have. Somebody will have. So
I asked him
yeah.
what do you have for emergency fund?
Yeah.
He said, LAS. My father is a CA, so we know LAS is very cheaply available. So everything in equity. I have taken LAS limit, so I can withdraw money anytime. I can call the money anytime through app. But, and this guy was 36, 37-year-old, right?
I know people like who have taken loan to invest in equity. So it's more than 100% allocation in equity in some ways.
But like I said, they probably have at the back of their mind that somewhere in the family there will be some backup plan somewhere. I suspect.
Yeah, no, I mean the question is not about that. It's like they think that market delivering 12% return in 5 or 10 years is kind of 100%.
Right.
Investing basis, that hypothesis is a problem.
Right. So you expect the market to mature over the next decade or so. What are your plans in line with that thinking? How will your platform, how will your company evolve?
Yeah, so I think we will stick to fixed income products, right? We've done bonds, we have done SGBs. We are now going very aggressive.
SGBs meaning sovereign gold bonds.
We are now going aggressively on FDs.
And therefore you're regulated by RBI there as well?
No. So because they're again it comes under SEBI when you actually facilitate.
It's a listed security, so everything is under SEBI.
So you completely regulated by SEBI?
For FD is not regulated by SEBI as a product, right? So we are also bringing in Wint guaranteed bonds. So
what is that?
So we will basically issue our own bonds and deploy that money.
Okay, how does that work?
Actually, you want to?
So we are opening our own NBFC.
Okay.
That NBFC will raise liabilities, guarantee a certain amount of returns, and that NBFC in turn will deploy money in different bonds.
It's like a fund of funds.
In some ways, yes. The only thing is there'll be NBFC equity as well, let's say 20%. So that 20% cushion will be for any defaults which can take place. Let's say this NBFC is invested in 100 bonds. So one, there is diversification of those 100 bonds. Secondly, there is a 15 to 20% equity cushion. So even if 15 bonds out of those 100 bonds are to default, still money will be repaid to the investor.
That's starting to sound like CLOs. No? So let's explain this, just to unpack that a little bit. Can you sort of give an insight to the history of securitization in India, just in context of what you're just saying?
No, securitization is like very different. This is like pure wholesale lending that we are doing. Essentially, it's our NBFC which is raising money. So
but you're investing in other sort of loans, no? Or bonds?
That's what like a NBFC does, right? It gives money to other borrowers. So we can give money to retail borrowers or wholesale borrowers.
Okay. So you're not at a wholesale.
It can be either, or it will be both actually.
Right. Okay.
So it will be our NBFC which will be deploying money into various credits, retail and wholesale, and this NBFC is issuing bond to institutions, HNIs, retail investors, and so on.
And why are you doing that? Like, what's the sort of evolution?
Yeah. So
what's the benefit for you? What's the benefit for investor?
Yeah. So what we realize, I mean, this 10 to 11%, 9 to 11% bonds are good. We cannot go below that because then FDs become interesting. So we are bringing in FDs. If you go higher, there is some chance of default happening, realistic chance, right? So what we are doing is that those high risk bonds will be invested through our own NBFC, and there we have a cushion of equity, so the investors don't have any losses, and we'll also have higher margin, right? So it is basically then we'll invest in 100 bonds. We'll probably keep to 3% cushion, right? So if we are deploying at 14, we'll probably raise it at 11, that kind of thing, right? So it expands market for us, plus it gives us revenue depth, and it also it still gives a diversified exposure to retail investors.
What's your own ambition for your company? Where do you want to take it to in terms of size, in terms of listing, in terms of your exits?
We haven't discussed actually.
Yeah.
No,
I think
that can't happen.
Still early days for us, right? I mean, it's been only a 2-year
No,
old
it's
company.
like we definitely have ambition to build a large business, right? And
There are no like milestones ki 2025 mein IPO करना है.
हाँ,
I think
yeah,
it's
but
like very very early days for having such a discussion.
earlier that large business ka proxy was a unicorn. Now, like that proxy has now post 2021 has changed to a publicly valued unicorn, right? Somewhere there and could be beyond, but we don't have कि अभी पहुंचना है, इतना ही पहुंचना है, ये करना है.
At some point.
हाँ. If you keep doing the right thing, we will be there. Right?
Coming back to, I guess, how you guys met and how do you sort of divide the work between you? So can you maybe share some thoughts there?
So I don't know if you know, like there are 6 co-founders at Wint.
How did you all find them all?
Yeah, initially, like 4 of us came together. Subsequently, the initial 4 being Ajinkya, Abek, Shashank, and me. Subsequently, Vinay and Shruti, our 5th and 6th co-founders, came on board. All 4 of us are from IIT, but we did not know each other.
So
only Abik and Ajinkya knew from college days.
So I and Abik were like branch mates, right? We have hosted each other's bachelor parties, right? And we did our previous startup together. So I knew Abik very well. Shashank and Vinay worked with him in his previous organization very closely. So when I was starting Wint Wealth, right, I started meeting people, operating in the same segment, and I happened to meet Anshul, and he was exploring also something similar. He said, "Why don't we do it together?" Right? So we came together, and Shruti was helping us since initial days on product design. So then she came on board full time eventually. Right?
So to what extent do the founders need to know each other well enough? How many years should they know each other, do you think? Does that make a difference?
Yeah, it does make a difference. Like with Anshul, like when we decided, okay, Anshul, because he brought very crucial skill set that was required to run this business. But I and Abik had a discussion saying, this is a blind bet we are taking, right? All in all, just conversation. And obviously, it was from both sides. I mean, for him also, for us also. And it worked out more than great, obviously. So a bit lucky on that front. But I think founders should have worked very closely. You should have fought 2-3 times and then gotten back together. Right?
So did you guys fight eventually?
Like minor arguments we do have,
right?
But not a major fight as such.
Right. What about your previous failed startup? Tell us more about that. What did you learn from there that you're applying here?
Like I made all the mistakes of possibly first time founder.
Such as?
Like wrong set of co-founders. I mean,
what happened there? Like and that's exactly the point I'm trying to draw out. How can you get a co-founder sort of decision wrong?
Operating styles were different, and we are not complementing each other. I mean, we are still friends, right? With Venki. So there was nothing wrong in him or me. It's just that operating style were different, and we all were business guys. There was no tech guy, right? There was, and everybody was just a generalist, right? No specialist.
What was the startup? What did
it do? It was called creditperiod.com. It was an invoice bill discounting platform. It got acquired by Flexi Loans, right? So I think we were all generalists. Nobody specialist in anything. Nobody had even domain knowledge, right? None of the founders, right? So it was a pretty disastrous combination. Second, I think when we started Credit Period, the ambition of starting was something to make for ourselves, right? Well, that's not bad, but there was no customer focus or the problem solving. There was no framework driven, and in that process we realized, I mean, startups look like they're madness, but there is a method to that madness, right? So we didn't knew that method, or we didn't have that frameworks or how to operate in a startup. We didn't have any of that knowledge. I think these were the core mistakes, right? And then because these were so big mistakes that none of it worked, right?
So the domain knowledge is sort of, that's where your skill set comes in, right?
The financial domain, yes. I mean, like our other co-founders, Shruti, she brings in design domain knowledge. Vinay brings in growth domain knowledge. I bring in like finance domain knowledge.
Shashank brings in tech.
And what's your background, finance background?
So I've been in the finance industry for more than a decade now. Before starting Wint Wealth, I was in debt market only, like structuring these kind of bonds, but for institutions. A credit risk mutual fund will be my customer, for whom I'll be like structuring the NCDs. A foreign investor can be another customer, for whom we'll be structuring the NCDs. Similarly for banks, HNIs, family offices. And therein we got the idea, like these are good assets wherein a lot of these institutions are investing. How come we don't have any access to these products?
So Anshul has structured a lot of first time deals in India with pretty fancy words, right?
Yeah, the covered bond you mentioned, like the India's first covered bond, like I only structured in my previous organization.
Acha. And just diverging there, why did they sort of get discontinued?
So RBI brought in certain regulations. The structure of covered bond, which was being followed by the market, that structure was no longer complementing the revised regulations which RBI brought. So the regulations were not focused on covered bonds. They were focused on securitization. But in India, the covered bonds which were happening, those were like structured covered bonds, not under a specific legal framework. But drawing some regulations from the securitization, a structured covered bond was being like originated in India. Ever since the changes in the securitization took place, it had a ripple effect on the covered bond structure as well, and the structure was no longer feasible.
So your ambitions, did you have a failed startup as well? Is it mandatory
No.
to
For
have
me, it's like the first startup.
Okay.
A good thing is like Abhik and Ajinkya had done a lot of groundwork already.
Right.
So when I came on board, which was like 3-4 months after they started, ship was slightly more stable.
Right.
So like COVID was, at least the first wave was behind us. And ever since, like for me, it's like it was a different universe altogether. I'd worked in MNCs, companies like Deutsche Bank, Oracle, etc. Shifting from there to a proper startup hustle kind of environment was a different experience altogether. I think the initial 12 months, I was just adjusting to this new reality. But post 12 months, like I think I became slightly more comfortable. Now I think if I go from here to the MNC world, I won't be able to work there.
And in terms of background, you said all of you are engineers. Question I've always had, given that engineers don't become engineers, I mean, you do engineering degrees and then become entrepreneurs, what is it about the IIT or engineering background that helps in a startup?
Personally, for me, what changed after going to IIT is you see a vast of brilliant people who work on X teams, right? And that just opens up you to the new reality, saying this also is possible, right? The bar is high in particular. And it is about every other mundane thing, right? There were like some gamer who played so well that he can play continuously for 15-16 hours with such a concentration and he'll still rule the game, right? Then somebody being insanely focused on fitness, right? Insanely focused. Somebody being so good at studies and being disciplined. Somebody being so good at sports, right? So I think just that your mind opens up to possibilities. You start thinking, right? And you start seeing like, okay, I used to think the bar is here, but it can be actually much higher and somebody... so that I think was crux for my IIT journey, and I do see that for other people. Saying,
but nothing in terms of engineering itself that helped?
It does help. For me, it didn't much. Probably.
I was hoping for some philosophical answer like systems thinking and we see the whole and all
actually,
that.
It didn't develop for me.
No?
That all journey started me once I had a failed startup. I think because till then I hadn't faced failures. Right. Once I faced failures, I think something is wrong, something I definitely... Then I started reading and then eventually I developed these mental models or frameworks or playbooks, whatever you call it, right?
And failure was what? You didn't get revenue or did you lose your money also?
Yeah, lost money. But lost money was a very... like we couldn't make something that was picking up for customers, right?
But you still have a backup in terms of your family?
Yes. Been very lucky on that. I'm always grateful for that.
What about all the other co-founders? Do they all have backups?
No, in fact, Abhik didn't have any backup. In fact, he had some family responsibilities. So when we started Wint, I had to put in money in the company so he could draw salary.
But all of you draw salaries now?
Yes.
Now, yes.
Yes. Okay.
I didn't draw first, I guess, a year or so. But then
Any other lessons for wannabe fintech founders? In terms of whether it's the pace of the Indian regulation, whether it's the pace of technology. For example, we haven't discussed how does AI, ML, quantum, any of these affect your business going forward, for example?
One insight which I have is like in the founding team, both skill sets are important. You can't have only tech founders running a fintech startup, and you can't have only finance guys running a fintech startup. So it's good to have like domain expertise of both the areas.
When you say expertise, and this is just something I'm just putting out there, it's one thing to have theoretical knowledge, and it's another thing to actually have lost and seen some market sort of ups and downs. I remember when I was a research analyst and I went to interview this really sort of reputed fund manager, and he said, okay, do you know about the 87 crash? And I said, yeah, I've read about it, very enthusiastically. He just looked at me and said, you don't read about crashes, you have to live through them. And this was my initiation into kind of the market. And I realized that much later what he meant. Now I can see patterns and say, okay, I've seen this before, whether it was the late 90s or the 2000 or whatever. I'm just asking you, in terms of young people wanting to become founders, from a finance sort of industry point of view, to what extent do you think that having seen those cycles is important?
It matters. I mean, like, if the fintech startup is in the investment space, yes, experience along with competence and knowledge is a prerequisite. But if it's, let's say, something like a credit card issuer or like something which is not core investech per se, I don't think experience is that relevant. I mean, we have seen other credit card startups take off in a big way, and the founding team has been young. They had like finance domain knowledge, the regulatory knowledge, but not experience per se. But yes, if you talk about the investment world, wherein you're handling other people's money, the founding team and the team which is running the show needs to have seen those cycles, needs to have those experience. The CRO should be experienced, and all those things should be there.
Okay, so let's just sort of wrap up. Any other sort of advice that you want to give to wannabe sort of founders?
Like in fintech space, don't underestimate the regulations. You can't scale by operating in gray. So try to develop a product which is compliant with the regulation, which the regulators will want like a market to adopt, because you can't fight the regulators. And this we have seen like in multiple startups. And always be like a customer focused. Don't try to impose your product on the customers. Do it the other way around. Develop a product which customers need. I think if these two things are there, the startup will succeed.
What about your experience with VCs? Any sort of, not lessons, but any insights as to how Indian VCs operate?
I think Ajinkya will be better to answer this.
A bunch of lessons, I mean.
Please share.
No, nothing specific. Like how I learned now to approach VCs is like they're a customer giving you money, right? So how you do a deep dive on customer, understand, and you build GTM. That's how you do with VCs, right? Why are they giving you money? And what are you going to do with that money? What kind of returns do they expect? Can you give that return? That's the basic question, right? And are you okay to walk that path? And obviously it has a very rosy side, but are you okay to walk the dark side also when it comes? And now we are seeing many startups in that dark zone, right? If you look at VCs as customers and just start doing this, like how you approach customers, right? You'll understand them well. You'll have JTBD, ETC, bunch of these things, right? And then I think it becomes far easier, right?
What's Rainmatter as a VC like?
They're not VC, and they're in true sense angels, right? The angels, right?
Right.
They'll give you money.
Why do you think they invested with you?
I think fixed income as a thesis, Nitin was very keen to invest in, and I think we could like something greater than FD, but less risky than equities could be one first product for many stepping investors into the market is what Nitin believed, and we also believed. So that was, and we could create products or we could structure products. I think that Nitin liked. But I think Nitin is the better person to.
But you have other VCs now, right? You have other investors. So does that create a conflict when sort of your different investors have different objectives?
No, Nitin has no objective. I mean, Nitin is like, this good for market. You seem to be.
No, but do other investors then sort of say, for example, start nudging you in a certain direction? What do you do then?
Yeah. I mean, they are nudging not out of bad interest, right? They think that's best for the company. So you have to listen to it with open mind and do whatever is the best for the company. With Nitin, I think when actually we signed the deal and I asked Nitin, do you have any advice for me? He's like, dude, you seem to be a smart guy. Don't ask for advice. And in fact, he has never asked me once saying how's the business going and you should do more. Every time I meet Nitin, he's like, you need to take care of your health, right?
And do you?
No, I've started this year. I've definitely started.
When you said, for example, what IIT taught you is that people working at extremes, Is that a good example to set anyway? I mean, if anything, Nitin should be sort of giving you the example of the opposite, right? Where work-life balance is more important, happiness, mental health, all of those things are more important. The point though is, can people become super successful with that attitude? I know he's got there, but your take
I
on
think
that?
luck plays a lot of part. There are a bunch of ways to be super successful. And you cannot decide that I want to be super successful. I think you have to just keep doing the right thing. And at some point in time, you have to be massively lucky. Right? And you have to optimize for that luck. You can obviously, there is no short recipe of making. You have to keep doing the process right and keep improving on your craft. And you will be decently successful by that. I think being decently successful and super successful, the luck is more of a 90% factor, I think.
How do you define success?
What it means for you? I mean,
But I'm asking you, how do you define success?
I think if you have 10-20 million customers using our products, that will be a huge success for us. Right?
Okay.
I think because of Wint Wealth, if we can like improve the financial well-being of our customers at scale, is what we define as success.
Right. That's for Wint Wealth. Personal success, how do you define?
I think doing something impactful is something which will give me satisfaction, and mental peace is something which I like really crave for. And I think doing something impactful, good for society, good for customers, will give me mental peace.
So if you get trolled on Twitter, does that bother you?
Not much.
Actually, you haven't seen that kind of
Trolling,
trolling yet.
yeah, actually I haven't seen it.
You have?
No, I haven't. I mean, it's one thing to do a thought experiment, and one thing to actually, like, it's similarly like studying a crash and living through the crash.
Yeah.
I've met some people who have gone through trolling and heard their story.
I mean, I hear of influencers being trolled right now every single day. But I've heard Nitin say, like, he doesn't obviously get bothered by just because there's some issue with the Zerodha platform and somebody says something on Twitter. It doesn't bother him, obviously. But I mean, I know I've not been trolled so far, but it would bother me if someone said something about my product. Would it bother you?
I think wherever there is criticism, we try to engage and understand. But some people, like, trolls are like that. They want to troll. Then we can't do much. Then it doesn't bother me. I think if they have fundamental concerns and I look at it very objectively and there is some merit to it, then it does bother, saying how can I solve it?
Right.
But sometimes people just want to, right, they get that sense of power by trolling someone.
Right.
Then you can't do much.
Right. Last question. Other than Nitin, any other sort of big influences?
Personally?
Yeah.
Personally, another investor that I'm very close to it and got very inspired generally how to operate is Mr. Ganesh Rao. He's angel since day zero or day -1.
This is the guy who said, no matter what business you do, I'll give you money, right?
Yes.
I heard that. Why is that? Why did he want to give you money?
That you can ask him. But what I like about him is how he operates, right? And how he thinks in general, right? And people who have so much money, how they operate and what life means to you, it just gives you perspective, and something that is very interesting how they look at life in general. Right? You get to learn a lot. Right?
I mean, I haven't met these guys, but I like follow them on their writing, interviews, etc. So guys like Anant Narayan, who is now SEBI ED, Nilkant Mishra, who was ex-Credit Suisse, now with Axis Bank, Raghuram Rajan. So these are guys like who give this different perspective about country, economy, etc. And I like their perspectives, like very different perspectives between these three guys. But I like following them.
Well, thank you very much for making the time today and sharing with us how you built Wint Wealth from scratch. Thank you again.
Thank you.
Thanks.
Thank you.
Thank you.
It was a nice conversation.
Okay.
Thank you.
Thank you.
Thank you.